Joining us now is Bloomberg best economist John Herrmann. He's the senior fixed income strategist at State Street Global Markets. John, good to see you here on Street Smart. You know, you were at the upper. Thanks so much. You were at the upper end of estimates, looking for a gain of about 71,000, and that even the actual number beat your estimates. So, was this hugely positive in your view?
Oh yes, we're gonna just take a quick rundown, but overall, we were very pleased with the report. We thought it was a very decent gain. We were actually impressed by a couple of components within the report that suggested it was actually a little bit better than what the headline suggests. And we also want to just make a point that we just narrowly missed revising the unemployment rate lower and rounding lower to 9%. So what I thought was a little bit impressive was we had very, very good gain of what we call production and non-supervisory workers. We had 166,000 gain there. Their wages, their income, actually, not the wages, but their income, their hours worked and bodies and length of the work week and their wages, that grew by 0.6 in the month of September. And that's going to support, when we see retail sales next week, that's going to support about an 0.8 rise in retail sales next week. So we saw basically a couple of very, very good developments. I think what it suggests is that, you know, in terms of the U.S. slipping or sliding into recession, that's really not on the table right now and probably won't be on the table for the next 4 months or so. And at this point, it's really going to be a shock coming out of Europe and how well they manage things over there. That's the predominant risk to the economy right now.
Where would you put the odds of a recession at this point?
Again, you know, that call is going to be closely tied to the extent to which we see strong leadership in Europe and an aggressive policy in promoting a solution or a series of steps in a positive way. So that's the real issue. I think the economy is still a little bit on the fragile side. So let's say handicap it closer to 30%, maybe a little bit below 30. But the economy is coming out right now, it's ending the summer with some pretty good momentum. And here's one subtle point also beneath the surface. The inventory cycle that a lot of people were looking for in the third quarter is a little bit more subdued than what people were thinking about. So what that means is that we're going to have to step up inventories or step up production in the fourth quarter and especially in the first quarter of next year. So that suggests that the economy is not quite so vulnerable to a recession in the first quarter as I was definitely thinking. So I think there were several positive points, but I think that's the crucial one. We have decent momentum, good wage growth, all the forward-looking indicators, hours worked, temporary help, these kind of things were all positive in the near term. And I think now if we just get a little extra confidence, just on the private side with consumers and businesses, we could build ourselves some momentum here, and that would be very good.
All right, John, you're refreshingly optimistic, but I'm going to refer you back to one of your own charts. It's called the Severity Index, which in your last note pegged us at what you would say were post-1930s highs. Well, explain it to us. It does look quite severe.
It's very severe, it is very daunting, and it's very concerning. So I just mentioned a bunch of the short-term positive influences, but this is a persistent problem that's been with the economy since we began recessing a couple of years ago. And here's how it's built. What you have to do is you have to take the unemployment rate and then weight it by the average duration of the spell of unemployment, adjusted for the labor force, and then basically what you're getting is you're handicapping the risk that if you were to lose your job, how long would it potentially take you to re-enter, to get back employed. And more or less, we are at the worst in that sense, the most severe in that sense, since the end of the 1930s. So what that suggests is that the strains on the families of the long-term unemployed are very, very deep. And we need public and private solutions to these problems. And we're going to have to encourage businesses to hire these people through some sort of tax break, or, we have tax breaks right now for capital spending, but we're going to need tax breaks for this. We're also going to need to support these families in getting training that they're going to need to re-enter the workforce.
John,
and we're really going to have to push that.
Very quickly, because I don't want to run out of time here, connect this back to market reaction today, specifically the Treasury market. We're seeing a sell-off at the long end, which is a bit surprising.
Yeah, well, basically what we're seeing is continued. We're looking for a flattener between 10s and 30s. That's been our preferred trade for the last 7 or 8 days or so. It's working very well. But what it's doing is that markets are saying, it's a sigh of relief from the Treasury markets that we're not at imminent risk of a recession. So it's a sigh of release. We still have concerns. That's reflected in the fact that we're close to 2% yield in the 10-year. We still have concerns about the outlook, but we're not at imminent risk of recession. And the 10-year note, Treasury note, basically had a big sigh of relief this week.
All right. Thanks so much for that interpretation. We've got to leave it there, John. Thanks so much.